From the morning reading, Spiders, Diamonds break out and hit all-time high close. Earnings season, Alcoa, Monday, July the 11th after the close. All 9 sectors moved higher on Friday. XLB, XLI, and XLF were the strongest sectors, while XLP was the weakest sector. Oil futures fell 7 cents to close at 45.12. Breadth strengthened compared to the prior day as advancers led 26.66 to 359 on the New York Stock Exchange and led 21.61 to 450 on the NASDAQ. In other morning reading, the S&P closed at this new 52-week high. Using weekly closing prices, this is the first new 52-week high in 50 weeks, the third longest dry spell in 20 years. Going back to 1928, the S&P sets its first 52-week high in nearly a year. It has led to mixed, shorter-term returns, but positive medium to longer-term ones. On a better-than-expected payroll number, almost everything rallied. It's rare to see stocks and bonds both rally in the prospect of better economic conditions. When Spider, Tilt, and GLD all rallied on a day that the non-farm payroll report beat expectations, stocks fell over the next week every time but once. The buying pressure was broad-based. It wasn't just other markets that rallied, it was almost every stock. Among companies in the S&P 500, actually the 1500 index, 1,469 saw their stock prices rise on Friday. That's the most since 2011. Money is flowing into investment-grade bonds. It was mentioned earlier that LQD earlier this week, and over the past week, the fund's total inflow has now exceeded $2 billion. That's more than double its previous one-week record of $900 million from late October 2015. This typically is not a good sign for future short to medium-term performance of the fund. Further, major stock indices near their record highs. The New York Stock Exchange Composite Index nears upside breakout. Small caps turn higher. Consumer discretionary and industrial ETFs achieve bullish breakouts. Intel and semiconductors lead NASDAQ higher. Major stock indices near record highs. The strong job report on Friday helped push stocks close to record highs. The Dow Jones Industrial Average jumped 250 points, or 1.4% on Friday, to reach the 2-month high. A test of its April high is imminent. The S&P 500 looks even stronger. The daily bars show the SPX rising above its June-October highs to end at the highest level since last July. That leaves the SPX just points away from a new record. The Thursday message featured the New York Stock Exchange Composite Index nearing an upside breakout from a bottoming pattern. The chart shows the New York Stock Exchange climbing 1.5% on Friday to end just shy of its neckline drawn over the 8 months high. The belief that an upside breakout is likely continues. Market breadth is also positive on Friday, with a big board advances leading declines by a 7-to-1 margin. That is enough to push the advanced decline lines to new records. Higher prices usually follow. One of the factors holding back the New York Stock Exchange Index is that it includes more smaller stocks that will start working in its favor. Cyclicals and industrials turn lead. Another encouraging sign for the market is that this week's upturn was led by economically sensitive stock groups for a change. Cyclicals were the week's top percentage gainer. The chart shows consumer discretionary XLY surging on Friday to the highest level since last December. Its relative strength ratio also rebounded for the first time in 2 months. An upside breakout in home building stocks led the advance. Home improvement and apparel retailers also helped lead the XLY higher. XLI breaking out to a new record. The XLI was led by heavy construction stocks and rails. The XLI SPX relative strength ratio turned up during February as the market bottomed. It looks like it's getting ready to lead the market higher again. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:21 a.m. Mountain Time, and I'm recording this in preparation for the market day of July the 11th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, so some pretty interesting things happened last week, of course, as you heard from the morning reading. Let's go ahead and dive into the morning report and see what kind of continuation we might be getting from that. Right now, it's positive. The U.S. indices, all four of the broad market indices, are up, with the S&P up about 7.5 points, or about 1/3%. Russell futures are up about a little over 0.5%. Dow futures up just below 0.5%. And NASDAQ also just below 0.5%. And overseas action, all positive. China up about 0.25%. Hong Kong up about 1.5%. Japan up sharply, about 4%. Germany up about 1.5%. The United Kingdom up about 0.75% or so. In terms of macroeconomic reports for today of significance for the U.S., we've got FOMC member George speaking. And that looks to be about it. And looking forward to tomorrow, we have FOMC member Bullard speaking. The JOLTS job openings. There is a 10-year bond auction. If you're a bond trader, you need to be aware of that. And that looks to be about it. So fairly quiet beginning of the week, other than some members of the FOMC board doing the speaker circuit. In terms of current market conditions, as you would expect, the volatility has been getting crushed. Short-term VIX is down to 11.43. And when we go to the charts, we'll note just how fast this crush has happened. Skew just barely into the warning status at a 127. IV percentiles are getting into single digits on some of the indexes now. The S&P's at a 7, the Dow's at a 5, Russell's at a 21, and the NASDAQ at a 10. There were 2 standard deviation moves put in on all 4 of the broad market indices on Friday. So that is a very, very bullish sign. The way it closed was also quite bullish. The tricky part here, let's go ahead and go to the charts, is that we have just gotten to the point where, just a second here, I usually like to do this in white for you guys. So I'm told that it's easier to see. But so if we look at the Smp Futures, you see we kissed right up to the top of the area of resistance on Friday's action, came up right close to the top. And then last night, we actually, look at this, we went right up and kissed the very top. Now, we've backed off of that. And see, that's part of the fear. Now, depending on what you look at, if you look at the SPY, it looks like, you've cleared these some of these more recent swing highs, but there's still some, especially if you go back to the bull market high of May of 2015, you're still just shy. SPX, also the same thing. You see here, this actually is last July swing high. There's a 2134 out there as last May of 2015 high. So we're right up against the very top of the resistance area. We clearly have broken out in a number of definitions, but you really would like to see a clear breakout, and this isn't measured by a certain percent or a certain number of points, but you'd like to see a clear breakout that clears all definitions of prior highs, whether you use an SPX, SPY, the S&P Futures continuous contract, whether you're looking at the S&P or you're looking at the sector components, you'd like to see those all start to clear. If this bull market is really got real legs to it, and we're going to start legging in and redefining an extension to this bull market, we can't fail here. And perhaps especially this time. I mean, when I look at the S&P Futures, I mean, look at this. I mean, we go up and we kiss to the point, 1 point away. The prior swing high, let's go back to 2 years, see if that number is right for the 2-year number. So yeah, 2134, you know, from 2 years ago. So in the Globex last night, we go up to 1 point away, and then from there, we now back off, and we're currently trading at about 28. So, you know, we go up to 1 point away, the all-time high, and then we back off several points. Now, obviously, volume's thin in the Globex, and, you know, there's lots of games that get played on that thin volume, but it's still one of those things where, you know, as we come up to this area over and over again, and we just fail, we just keep failing. Well, I sure hope that for the bull's sake, we don't fail this time, that we actually do establish a real new bull market high. If we do fail, that doesn't mean the end is near, but it probably means that we're just going to chop around like we have in the past in these kind of sideways patterns, sometimes getting something that's a little bigger, but then the next thing you know, the bulls have you right back up. So it's just kind of this sideways chop. So that's kind of the most probable alternative to a successful all-time new high. Now, a couple things that some of the morning authors mentioned I want to build on. When you have and they're starting to call them the stubs, you know, the staples, utilities, the long bonds. When you start to have the utilities, you know, they've been doing well, but they started to pull back a little bit. And then XLP, you know, obviously the staples were doing well on Friday, but everything was doing well. But in a relative sense, while XLP did well, look at XLI. XLI is really taken off at the end of last week, and that's a much larger move relative sense-wise on XLI than it was on XLP. But again, just right up into these prior highs, and, you know, not really leaving the area yet. You'd like to see this thing not just get to, but actually leave the prior area. Let's go ahead and go to Dow Futures. You see it certainly made up a lot of ground. And then with the Globex action last night, you know, probing up above these prior swing highs that we have on the Dow Futures contract. NASDAQ actually looking into a diagonal breakout. And you notice the line that we had drawn here with last night's action probing up above that. So you have to kind of give some points to the bulls here. They really are making a try for this. Just don't get too far out in front of this, because this is still at a point where you could have a breakout failure. We haven't cleared the area yet. It's my primary point that I'm trying to make. And here the Russell. So for all this action, the Russell still hasn't even cleared its diagonal breakout. So even with the Globex activity of last night showing here, we're still right up against that area of resistance. So while the headlines are sounding super, super joyful, and perhaps rightfully so, because the bulls were making a dramatic statement last week, don't make more of it than it is until we have an ability to leave the area, as it were. Now let's take a look at some of these confirmation markets. And one of the morning authors mentioned about how bonds was up. And you look at, Friday, we had bonds at an all-time high. And then in the Globex last night, we actually went a little bit higher. It's backed off a little bit right now. But the bottom line is that bonds have also been going up. So as my wife and I were talking about this over the weekend, it's like, the bond traders are considered the smartest of the smart. And this is a huge market. And there's a lot of things going on, including, what's going on with the negative interest rates in parts of Europe and other places. Well, if you really believe and that this is a big time opportunity for a broad-based equity bull market leg, then why are there so many people in bonds? And it seems like this money should be coming out of bonds and going into equities, and that is not happening yet. So there are some signs here that, maybe this isn't quite as obvious or as believed as deeply as possible. We also have talked about how crude oil has been in such a high correlation with equities, and yet, what has crude oil done at the end of last week? Well, crude oil actually broke below the symmetrical, or actually the ascending triangle pattern. This would be the least likely expectation, and has actually been trading below that action. So if this doesn't quickly reverse and just nullify this probing activity below this key support area, you're going to have a non-confirming indicator from crude oil and some of the commodity complex. Let's see if we can get this up quickly. Here's your ETF for the commodities. They're looking very much like the crude oil. So commodities certainly aren't showing at the end of last week an increased confidence in the equity market. And then let's take a look specifically at gold. Gold, again, all-time highs. So if you have gold, people are not leaving gold. If you have bonds, people aren't leaving bonds. Commodities aren't following. It makes it kind of difficult to argue that there's deep, broad-based confidence that we're actually setting up for a big bull leg. So it's just a pretty complex situation right now, and I just want to caution against getting too giddy that this thing is about to leg up, several hundred points on the S&P in the next few weeks. This is the strongest case we have made for doing just that in a very long time. But at the same time, there are signs here where some of this is a bit questionable in terms of, belief across all sectors of the market that is going to happen. So that's probably enough with the charts right now. Let's go ahead and go to the daily report. And the daily report is in pretty much universal agreement that this is a strong bull market, and indeed our market trend intermediate term phase opinion did finally capitulate and leave the phase 5 and go to phase 2 into a bullish signal. This is called the trend reversal, the break of diagonal resistance. All three of our market timing signals, which are mechanical in nature, are lining up onto the bull side. IBD has confirmed uptrend. The GMI index, a 6 out of 6 with a buy signal since July the 1st. Decision points, perhaps is the most muddled one in that we do finally have a clean stack across all the indices for the short to intermediate term. So a lot of healing has gone on here in the last 2 weeks. But we still have this long term with these signals that are bearish against other signals that are bullish. So some mixed signals in the long term on the decision point scoreboard. But that's the only thing that is keeping this from being that perfect stack that we like to look for, is kind of the sign of, long-term trending markets. So very, very strong consensus here now, moving to the bullish side. Position sizing opinions from both mechanical systems, as you would expect, are at 100%. Intermediate term market posture, severely strong bull for both the S&P and the Dow. The NASDAQ and the Russell both in the strong bull category, so no warning signs there. The strength of this trend, no warning signs there. We're pointed up. In terms of the special volatility-based indicators, well, the volatility ratio warning has been crushed and is now in looking for a firing signal, but that firing signal has not fired. So this is a caution, but it's not actually become real quite yet. Your skew was just barely over a 125, but that's it, folks. Everything else here, so we got two kind of borderline signals, but everything else is in normal bull stance. On the trend base, everything is in normal bull stance. Even had a very strong signal on the New York Stock Exchange, new highs, new lows indicator. In terms of the key intermarket risk aversion indicators, we've had two now go risk on, and one that is rolling up and is ready to go risk on. We've been watching to see if this one would start to respond. We normally put quite a bit of confidence in this indicator as being very sensitive and kind of a leader. And it's been dragging its feet in terms of signaling confidence in or confirmation in this bullish move. But it's certainly starting to show more of that. So when you look across both these individual smaller indicators that we roll up and then ultimately come to our hedge warning status, which we have at a level 1 right now, I'd like to see us clear these resistance areas before dropping it into the normal level. Probably would go to 0+ initially. But that's the only thing really that justifies being at level 1, is that the pot odds are just so poor being right up against these key levels of resistance. In some cases, though, we're starting to break through. So signs are there that this could be dropping and that we could be setting up for something, very strongly bullish coming forward for the next few weeks. But, the big but. Just be careful to see that this actually does follow through before loading up the boat with all kinds of high beta positions. In terms of special opinions, we've had a couple changes here. Option income strategies, no change here. VIX is in the acceptable window to initiate new positions. In terms of covered calls, we had some changes here, and for put selling, conditions are acceptable to initiate new positions, period. You might want to consider using a 1-to-2 ratio now of in the money and out of the money strikes, so more offensive, as it were, not quite as defensive, but not yet all out offensive. You also might want to consider using a spread of low beta and high beta positions, but we're starting to go with more high beta positions, so starting to open up the offensiveness of your portfolio posture a little bit. On those aggressive setups, you might consider legging into those. Let's see if this breakout actually follows through before getting particularly aggressive with those more aggressive high beta positions. In terms of put selling, kind of a mirror there as well. The aggressive setups might want to use defined risk positions, position size and scale that you're willing to own, as always. So you see this starting to open up, and this is a reflection of how the market posture and market conditions are changing, and yet being careful not to get ahead of ourselves until we see some proof positive that we're really clearing the area and not just going to just tickle once more and then fail again and then have egg on our face with a whole bunch of fresh positions that are kind of highly aggressive and high beta and so forth. We're frankly a bit more conservative than being able to jump quite that fast on changing conditions. We'd like to see a little bit more confidence develop across the market before we get that aggressive. Now, that being said, if this does successfully break out, then we start opening up the wagon, as it were, and start putting on more bullish swing trades, diagonal strategies with swings. All these different kinds of things will start to open up using more leverage, more aggressive leverage, and more high beta kind of go for it kind of aspects if this starts to fully mature and develop into something of significance. So we're starting to get our watch list kind of honed up and start thinking about those things, which it's been a long time since we've really been overly aggressive about those kinds of strategies, and yet at the same time not quite ready to just put on 10 or 15 new swing trades today. Okay, I think that's probably enough for this morning. We're up over 20 minutes by a long shot. This is typical with our Monday messages. We'll go ahead and get to our disclaimers. Hit the disclaimers, review those. If you need to hit the pause, you need more time, do so. I also note the full disclosures down here at the bottom. That'll take you to the full set of disclosures, that hyperlink down there. And in the meantime, we'll see you back here for the next session. Hopefully we'll see some follow through to the bulls action and see the market start to gain some confidence. In the meantime, manage that risk and don't get out ahead of all this. We'll see you soon. Good trading.